Hello, and welcome to our market alert video for today, which is July 28, 2023. And I am Ken Moraif, and I'm the founder and CEO of Retirement Planners of America. And you, if you are watching this video, are not a squipper. And you're thinking, well, what is a squipper and why am I not one? Well, because if you are a client of ours and you have retired, then we call your retirement your second childhood without parental supervision. And the acronym for that is a squipper. So we want all of our clients to become squippers. We want them to retire and enjoy that second childhood. So if you're watching this, you're not a client yet. So go to our website. It's rpoa.com and see if maybe we can get you to become a squipper. So let's talk about the data that we got this week and how it impacts our fearless forecast and where we think the markets are going to go and where inflation is headed and all of that good stuff. Well, we got some important data. Number one, of course, is the 800-pound gorilla in the room, and that's the Federal Reserve. And they, in fact, did raise interest rates another 0.4%, just as we thought they would, and many others did. And so that was not really a surprise. However, we did get some additional data after that, which was the gross domestic product, GDP. And that is basically all the goods and services that are produced in the United States. And that number came in very strong. So what does that mean? Well, our fearless forecast for the rest of this year, we said that we thought that inflation would bottom in June at around 3%, and that's what it did. And so now we think that the inflation is going to start picking up again. And we think that by the end of this year, it might even be at 4%. Why? Well, the GDP number came in strong. The economy is growing at a very fast pace. And the Fed, despite all these interest rate rises that they've been doing, don't seem to be affecting that. The other thing also is that wages remain very strong. And as wages are inflationary right now, they're very high. The unemployment rate is at historical lows. So, the Fed is trying to, believe it or not, get unemployment to go up. They're trying to get wages to go down. So they're trying to get inflation out of the system. And then the other thing, of course, is that as the economy continues to be strong and all those drivers of inflation, the Fed, most likely in our view, is going to need to raise interest rates again later on this year. A lot of people are not anticipating that. A lot of people are thinking they're done or inflation is going to come to heel. Well, we don't think so. We don't think the Fed will be done until next year. So what does that mean? It means that we could see some volatility in the market as people come to the realization that the Fed's work is not done, that there is more work to be done. If they raise interest rates too high, too fast, they could cause some severe damage to the economy. So far, we haven't seen it. But keep in mind, there's a lag between the time that the Fed raises interest rates and the economy feels the effects of that. And that lag is between a year and a half. So a lot of most of the interest rate rises that they've made, including this one, the effect of that won't be felt for a while. So is there an oncoming tsunami? You know how the tsunami kind of goes back, the big wave goes back it recedes and everything seems to be okay. And then all of a sudden there's the big wave. Maybe that's what we're looking at. So there are two areas that are of concern. The first, of course, we've talked about in the past, and that is the commercial real estate market. Massive amounts of money there, loans like hundreds of billions of dollars that are going to get renewed at higher rates, and these companies are going to suffer, and some of them may not be able to refinance, and they could go bankrupt. That's a massive problem, a big time bomb that could go off. The other thing is small businesses. 60% of our economy is small businesses. And small businesses are suffering under these high interest rates. For them to borrow money now, it's around 8%. And that's very expensive money. And some small businesses may not be able to afford that. They could go under. And if that's 60% of the economy, that could present problems too. So where do we land on all of that? Well, we think that between now and the end of this year, the stock market, the S&P 500 index, the Dow, et cetera, will be higher than they are today. That's our view. However, between now and then, as the realization that the Fed is going to have to do more work becomes more entrenched and people start to see it our way, then we think that the market will be volatile. It'll go down potentially 5 or 10%. as it kind of the people who were overly optimistic leave and the people who buy on their backs come in. But always, always, always in our view, even though we have a positive view for the rest of this year, we think you should always have a strategy to protect your retirement. That's why we have a strategy. It's called Invest and Protect. It told us to sell in November of 2007 before the stock market crash of 08. It told us to sell in April of last year and get out. And guess what happened after that? The market went down significantly last year. You may remember that. So our goal is to protect your money from big bad things and have your money last as long as you do. And then we think you can enjoy that second childhood without parental supervision. And if you're our client and doing all of that, you're a squipper. So go to our website. It's rpoa.com. There's a link below this video that you can click on. Thank you for watching this video. Share it with as many of your friends and family as possible. We want to help as many people as we can. So again, thanks for watching, and we'll talk soon.